Hey everyone, Michael here at OptionSplayers.com. I'm an instructor, and I'm going to be doing a few, let's say, videos on different price action patterns that you may want to look for. Um, Really, very, very few indicators. Keep it simple. Stupid is a kind of my motto, and some things. Some of the things that I've learned over the last year, I'm starting to apply a lot more in options trading. The first one here is about high and low base patterns. I'm actually going to focus on low base patterns and give you a real world example that some may have seen me announce in chat just before open on Tuesday on Crowd CRWD. Um, First disclaimer: Options Players is not investment advisory service. We're not registered investment advisors or broker dealers, and are not going to tell or suggest which securities you should buy or sell for yourselves, options included. You should always check with your licensed financial advisor and tax advisor to determine the suitability of any investment or trade. Okay. Screenshot this, understand it, and also understand that there is a high degree of risk in trading. Anything I show you here is going to apply to my personal success or failure rate. Right now, I'm generally right around 60% of the time. That means I'm wrong 40% of the time. No one is infallible. Not even the best trader out there, and I'm definitely not the best trader out there, is going to win all of the time. So take this with a grain of salt. Understand what your losses are and where you position size. So what I want to cover actually is a pattern that goes over and over and over in all asset classes. As many of you know, I do trade multiple asset classes, including some currencies. But my favorite is options. I love options, and it's really kind of the core to what I like to do. Equities or asset classes, they like to rest after a strong move. Okay, and they're going to rest or they're going to consolidate before they decide whether they're going to continue or reverse. Now, oftentimes what happens is they'll go up and boom, it just kind of goes sideways for a while. Okay. Or you're going to get some kind of consolidating move that is a triangle. Okay. So I love taking these types of trades, or they'll go down, bearish, and then you just kind of go sideways for a while. And what happens is it makes a decision either to break up or break down. So my personal preference is that if we are in let's just say this is a leg up and it consolidates, I don't like to take a breakdown unless we have a triangle. Okay, but I'm not going to cover triangles in this. I'll cover triangles in another one. Okay. I generally don't like to take those. I really only want to take trades that then decide to break up. And if it's a leg down, I really only like to take trades that are going to leg down. Okay, so they're going to consolidate and then continue going down. Okay, that's my personal preference. So as far as the conditions, what I look for, I don't use the 20, 50, or 200 simple moving averages in my day-to-day trading. However, I do use them to just kind of give a general idea of what I might be able to be watching for. And so the ideal conditions for a low base, I'll cover the low base here. The same conditions are going to be for a high base, is I want the 20 moving average to be below the 50, and I want the 50 to be below the 200. And I set up scans to tell me when the 20 is below the 200. I'm sorry, the 20 is below the 200. And I like to watch then, where is the 50 going? And the second the 50 crosses the 200 and the 20 is still below, I start getting excited. And these are the kind of the conditions I like to look out for. So I have different scans that tell me, and then I'll put stocks on a watch list that tell me when to go or not to go. And generally with equity options, I am only trading based on the daily candles. Now, I'm not going to tell you what this is. I mean, it could be whatever. It's just I'm not going to show the price. It's just kind of showing the conditions. Okay, so the orange line is the 200, the blue line is the 50, and the red line is the 20. So you can see that at this crossover right here, we now have the 20 below the 50 and the 50 below the 200. Okay, so that's the ideal condition for me. Next, what happens is I want to identify where it is that I would like to go short or buy puts on a low base, as an example, or go long with calls on a breakout if we have a high base, and a high base is going to be the exact opposite, where you have the 20 above the 50 and the 50 above the 200. So I draw a box and I let it sit, and you know what? It's going to have to mature. Generally, what I do is I take a look at where kind of a pivot high is, which is actually also a lower high, and then you're going to have a area of support on that lowest point, and it could churn a little bit. Eventually, it's going to break out of this box down below. That's when I want to actually take a trade. Okay. There's also a potential, but more risky way to go about it is you can go short by puts on a confirming bounce down from either the 50 or the 200 SMA. You can see that we actually kind of based a little bit here, let the 50 catch up, and then it bounced down. And usually I'll take a trade if we close below the 20, or actually some of the other key moving averages that I use. I use an EMA that is the 13 very often, but this is just kind of the condition. So you can potentially do that, but then in this case, for me, it's best to take a partial profit on the position if we happen to hit the lower end of the box. And then if it breaks out, great, I'm gonna continue the trade on down. Okay, so, but that's another way to do it. Okay, so here's where the ideal entry is. Generally, what I'm going to be doing is I'm going to be setting contingent orders, and it's just going to hang out there. It's going to hang where it's triggered if we hit a certain point. Now, I usually put it a little bit below the box on a low base. So my contingent order would be that if this particular equity or whatever asset class it is breaks out and hits that price level, then it triggers a market order to buy puts. Okay, I won't go through which strikes or which deltas or anything. That's another subject. It's just more how to read a chart and identify an opportunity. Okay, so the contingent order to go short to buy puts on that break. And this in this case would be a successful trade. You can see this is through TradingView. You can see what I'll do is if I am going to have a stop, I'm going to have a stop actually if we get a close above the one of the key moving averages, either the 50 or the 200. In this case, I'm just showing that the stop would definitely be out of the trade well before this. But if we happen, definitely it's a failure of the breakout of the base if you go back up above this. Okay, and you can see it just kept going down, and you can argue that we had this strong move. So we had a strong move coming down. We got a base. We break out, and now we have another base forming. And I'm not saying I would get out here if I've got time in my option. I'm already going to have a lot of profit, and maybe even the options will be expired. But if I want to continue, I can count that as a base, and any kind of breakdown out of this, maybe we take another leg. Okay, so that's a success. So let me give you a real world case study. I've been watching CRWD for quite some time, and let me just get to the chart. Sorry, I got to do that. Let me get to the chart. And I announced this in chat yesterday before open, what I really wanted to do. And here is CRWD on Monday at the close. Okay, so these are daily candles, and you can see that I've got the 20, I got the 50, and I got the 200. And I knew categorically that on Tuesday, I don't care where it opened, could have opened way up here. I knew categorically that this particular stock was going to have a 50 crossover. Okay, so I knew that. So that sets me up for a base, and my base was really kind of right in there. Okay, so I was really looking to trade. I was really looking to take some kind of trade as long as we were below 200. Okay. Because what happened is we had the 20 below the 50, and I knew the 50 was going to be below the 200. We closed below a very key level, which is 200. And as long as we traded below 200, I wanted to be short and at least try to make it down to the bottom of the box and exit a partial if I was able to get in, because I really thought I was going to do, and then convert, okay, or adjust or do something. Okay, so this is where we were at when I made that announcement. Okay, so I actually did get in. Okay, I got in, and indeed we actually had a gap down, came back up a little bit. I got into 180 puts for $2.50. Okay, and I set an order to sell them at a double, which they did. I actually 6 out of 10 sell them at a double, and then near close today, I actually converted it into a spread because I do believe that there's a good possibility we're going to continue to break down out of this box. So that I'm fulfilling my conditions that I really wanted to be in. I thought the risk was fairly low compared to the potential profit. I hit my goal by actually it exited before I got here, but I just wanted to double. Okay, but if I take a trade early in a low base, I definitely want to take a partial profit if we get down below here. And the partial profit was 60% of my position at 100%, and now I still have room to go if it breaks down further. If it doesn't break down further and keeps going in the box, I'm still locked in on my profit, as you might have seen. Okay, so as far as targets, there's a lot of targets. I mean, I'm sitting in an option that is expiring. I believe it's on the 22nd or 21st. That's when my option expires. I'm now in a spread. I've locked in my profit. And if we continue to go down below 170, I'm going to take the full profit. If it doesn't, that's okay. I've still locked in everything. But definitely bearish, definitely more opportunities for the future. If anyone wants to look at this a little bit further, and we do get a real full breakdown on this particular low base, it would be very easy to set a contingent order to trigger puts if CRWD breaks this line right here, which is the low. Okay, so we can actually adjust this box down to this level. Okay, so there we go. Okay, and choose whatever option would fit your style. On these box breakdowns, I tend to go out at least 45 days. So, kind of somewhere around in there, if it's possible. You're talking about the February expiry. And I generally personally like to take 30 delta options. Okay. Anyway, I wanted to get this particular type of pattern that I love to trade out. Again, it's the low base, and we're looking for a breakdown out of this for that next leg down, and there is a lot of opportunity. Okay, so set up a scan if you want to take a look at when the 20 crosses the 200, and then watch it for the 50 as well for that crossover. Or you can actually just set up scans that show the 20 is below the 50, below the 200. It just kind of gives you a list of stocks that may be setting up somehow for a basing pattern, and then you can take your trades when you actually make that break. Okay, so hope you enjoyed this video. Give it a thumbs up. Store it. I'm hoping that Steve stores this. We'll get some other videos out on other types of patterns over the next couple of weeks, and use it in your trading. And by the way, you can use this on any time frame. So you day traders out there, you could probably use this as well as me personally as a swing trader. Thanks much, everyone. Cheers.